Hello, Anthony. We are here today to talk about non-U.S. persons that are looking to become U.S. persons or perhaps looking to live or invest here in the United States.
Right. There are some pretty significant tax code traps, right? There's a lot of opportunities in the United States, but the IRS sets a lot of traps up. And so here we thought it'd be a good idea to talk about the four biggest ones that we see people run into all the time if they don't get the proper advice before investing in the U.S. or becoming a U.S. person.
Yep. Okay, trap number one, capital gains trap.
Right. This is a little bit hard to explain. I'll try to slow it down. And this is sort of the situation that we see a lot. A lot of our clients do pretty well in life, and there might have been a time in their life where they didn't have all that money, but they did have a lot of company stock that might not have been worth all that money. Now, as years go on, 10, 20 years, they have stock that is worth a substantial amount of money, and they become a U.S. person. Now, this is what happens. The tax code will tax you on your capital gain. So we'll look to what you sold it for and what you acquired it for. Mm-hmm. The way it is now is it will go to your date of acquisition before you were even subject to the U.S. tax code. So way back 10, 20 years. So if you don't get the proper tax advice, basically what you're selling it for, when you have an asset that appreciates substantially, basically everything you're selling it for is going to be subject to a long-term capital gain rate of about 23.8%.
Wow. In
addition, typically, if you are going to be in a state like California or New York, there's also going to be a state tax due. California's top rate is 13.3%. So you really want to get some good advice before you become a U.S. person. And the advice in this case would be, before you become a U.S. person, sell all your things, become a U.S. person, now buy them back.
Perfect. All right, now let's talk about foreign life insurance. And when we say foreign, we mean not U.S. life insurance, because to the person that's going to be coming here, it's not foreign to them.
Right, and that's sort of the code is consistent in that it's always saying everything else is foreign. Even though it's not foreign to you. Mm-hmm. So by foreign, they mean not U.S.
Okay. Now, 99% of the time, foreign life insurance is not considered life insurance by the U.S. tax code.
Right, because there are significant advantages to life insurance, U.S. life insurance, that you don't have to pay taxes on the proceeds, and whatever that life insurance policy is generating in income is all tax-free. So you could take loans against the death benefit, all tax-free. So it's fantastic, and you don't have any income to report year after year after year.
But the U.S. favors U.S. life insurance policies.
That's right. So when you have a foreign life insurance policy, they'll say, oh, that doesn't count as a life insurance policy for tax purposes. Basically, what you have is an investment. So you're going to have to pay taxes on it every year, and then you're not going to get the death benefit tax-free as you would with a U.S. policy. So there's some things you can do, though, to minimize those risks when you have a foreign life insurance policy. And also you might want to look into, if you're going to get a bigger policy, to get a U.S. tax policy. And that's true even if you're not going to be a U.S. person. A U.S. person has significant advantages to getting a U.S. life insurance policy. One more thing to add, this is the foreign life insurance policy, the IRS puts an excise tax on it, a sales tax. Mm-hmm. 1% of the premium a year they charge, and most people don't know this. There's a form, and the form isn't filed yearly. The Form 720 for your excise tax is filed quarterly.
Wow. And
this is one of as we review cases, we see people not doing it. And the IRS knows these are things, there's penalties they can assess and large taxes they can assess, because if you don't file one, they can go back to the date of inception from where you became a U.S. person to go after those excise taxes.
Okay, well, it's good to know there is a way around it.
That's right.
All right, now what about ownership of U.S. property by a non-U.S. person? We say first, if you're going to buy property in the U.S., it shouldn't be in your name for tax and liability purposes.
Right. The U.S. this is very common, even for people with substantial assets. They buy U.S. property, even their own home, they put it in their name. Not a good idea, because now if it's in your name, all of your assets are subject to the pool, the what somebody could potentially sue you for. In law school, this is true. In law school, in my civil procedure class, it gets talked about. Who should you sue? And I got the answer right. Who has the deepest pockets? That's what everyone is taught. So you want to make sure you're limiting your exposure. Don't have it in your name. That's really, really reckless. Mm-hmm. Now, when it comes to buying, a very common facts that we see is a lot of U.S. people investing in U.S. real estate. Maybe their kids are going to school and they want they looked at some properties that look like a really sound investment. And what happens is most people know, like, okay, I'm not going to become a U.S. person. I know I'm going to have to pay U.S. taxes on that. It makes sense if the property's in there. But the trap that they don't see is that that they're subject to an estate tax. That property that's located in the U.S., owned by a non-U.S. person, is subject to a very nasty estate tax. And it's not like the estate tax for U.S. persons.
Very different.
Very different, because that one doesn't set into, when you're way over $5 million, and those tax rates are different. This one kicks in around $100,000, and the tax rate is about 35%.
Wow.
And so it could be devastating. Now, there's ways to address this, and that's really, another thing where you need to get some advice before you start investing in U.S. property.
Important to note, too, that if you do have rental income, that rental income is taxable as well.
That's right.
Okay, now lastly, foreign reporting requirements. This could actually be an entire 10-minute video on its own, but we'll try to simplify and say there's numerous IRS forms that need to be filled out, sometimes quarterly, sometimes yearly, and it's things like foreign bank accounts, which again means not U.S. bank accounts. So if you are from China and you still have bank accounts in China, you have to report that. Right.
And it also might be things that you don't think of as bank accounts, that retirement plans, sometimes they consider a bank account, which isn't really, but that's where you need to know what should be put on what form.
Mm-hmm. There's also things like foreign mutual funds, foreign corporations, foreign partnerships. So you really want to get good advice on that.
And even when you send money, if you're even transferring your own money to a foreign corporation that you own, there's even a form for that.
Wow.
Yeah.
Okay. Well, if you're considering becoming a U.S. person, if you're considering buying property or living or investing in the U.S., definitely you want to get some professional advice. If you need some advice, don't hesitate to contact us at 888-727-8796 or info@irsmedic.com. You can look at irsmedic.com for more information. You can comment below and we'll get back to you. We want to thank you so much for watching today. IRSMedic, the law offices of Parent & Parent, LLP. Real tax attorneys for tough tax problems.